All right. Good morning, everybody. Seems like every day there's another update in Zoom. It never ends. It's all those widgets that they got in there now. Not necessarily a bad thing, just a thing. So another day of Powell, another day of waiting. Morning session should be a little slow. Afternoon gets the opportunity to stretch, but really not going to stretch too far because we've still got really big events later in the week. So kind of a mixed bag this morning. As you can see, everything is green. Dow's basically flat with the S&P, NASDAQ up about 0.25%, and the small cap's doing a little bit better. Powell did change the language a little bit yesterday. You got to remember, even 10 years ago, there was a lot of complaints that the Fed just did a horrible job of signaling its intentions. And they're constantly trying to work on improving their communications. But there's these subtle little nuanced things that they do for this communication. And some of that is to change the words that they use. They don't just come right out and say, we're going to cut, right? They can't do that. They have to give a little wink and a nod and start to hint at the idea that they're going to cut. If you remember, even just a few years back, when they were using this stupid phrase where it was something like, we're thinking about raising rates or some kind of junk like that. He changed the language yesterday just a little bit. And he actually started talking about how holding rates at these sustained levels are eventually going to break something, which, thanks, Captain Obvious. Tell us something we didn't know. The point is, he actually is starting to put that in there. And that's the first ray of sunshine, right? That's the first crack in the wall, so to speak. So a little bit different. We're looking for more out of it today. See if he expands on it a little bit. They're going to start out subtle and small, just like that one tiny comment yesterday, and then it'll grow from there until it becomes this obvious thing. But they want the market to work into that on their own, because the Fed understands if they can signal the right way, the market will do a lot of their work for them. All right. When it comes to raising rates, they did that the same way. They would signal that they were going to raise rates. The market would respond as if they already had raised rates, and that would do a lot of the Fed's work for them. So keep your eye on the September contract. See if the language that he used yesterday increases. You can see those contracts if you go to Google, just type in FedWatch. You should find the CME FedWatch. This is a free website. It doesn't cost you anything. You don't even need to sign up to get an account. Just scroll down on that page and you'll see the September FOMC meeting on the 18th. We're looking for a cut. Now, this page can be a little overwhelming if you've never been here before. There's two numbers. Just look at one of those numbers. Don't matter which one, just choose one. So let's just say we choose the front one. Current target rate is 525. And then look at these three choices down below. Well, here's what we've already got. There's our 525. So the one in the middle that has a 71% chance, that is a rate cut going from 5.25 to 500. We want to see if this is climbing or not. And we can do that by looking down at the bottom. Here's that 500 by 5.25. We can see that in one day it went from 70 to 71.8. So almost 2 points. A week ago, it was at 68. And a month ago, there was a 45% chance that we would get a rate cut in September. So in 1 month, we've increased. They're pricing in a rate cut. That's what we want to see. And of course, they'll back that up with November and December. They'll kind of bleed it out. It doesn't look like they're pricing in more than one cut. If they were, we would see these others start to rise as well. And it's not to say that they're not. We can come in and look. You know, we were at 11%, and now we're at 27 over the last month. They've priced in a more likelihood that we could get a couple of cuts by December. That's really just pie in the sky thinking, but it does show where the market is looking. So it's going to be another boring day on the idea that we're waiting on Powell. We can see small caps is running. That's good. It is worth noting historically, what happens when the Fed does actually announce a rate cut? Off the cuff, you would think, oh, the market will probably love the hell out of that and explode to the upside. It's worth digging into this if you haven't done it before. And as I always do, I encourage you to use AI to find these answers. You would be probably amazed at how simple and easy it is to use AI for things. The example that I have today is that we have the budget coming out today, the federal budget for July. Well, for June, we're going to get it now in July. So I asked, hey, what was the budget highlights from when we were in June? That would have been May. And it gave us some answers here, just like that. And if I didn't know what day it was, I could ask, on what day was it released? It was on June 12th. Okay, so we can go back to June 12th, 2 o'clock in the afternoon, and look what happened when we got the May federal budget released. Because I asked AI, I already know what the budget said. If it was good or bad, we can see the response in the market from it. We have this happening today, by the way. That's why it's worth taking a look. So what happens when the Fed announces a rate cut? Historically, what has happened when the Fed announces a rate cut? When they transition from either raising rates or holding rates steady and actually finally officially announce a rate cut, what happens to the market? Japan up more than 0.75%. The UK more than a half. If you were listening to the news this morning or checking headlines, I'm sure you heard it multiple times. Record highs, record highs, record highs, day after day of record highs. And it just keeps going. But if you read Spot Gamma this morning, well, the PM edition, we don't have the AM one yet. One of the things they pointed out is their downside target on the SPX. They're pretty comfortable with the idea that we're going to hit the lower SPX target before we hit the upper target. That would be 5550 in the SPX rather than first hitting 5600 in the SPX. We closed at 5576. We're basically 25 points in either direction to go, from 5576 to 5600. That would be a 25-point move higher. Go the other way, 25-point lower, we're at 5550. They suggested that it's likely we hit 5550. We hit that primary pin is what they called it, due to some magnetics of the pin. It's worth a read if you didn't read the PM edition last night. So the question is, how much is it going to cost to put some butterflies on both sides just to hedge your bet? If it's $5 for a butterfly, I mean, come on, you can't get coffee for $5. What's the worst that's going to happen? You lose your $5? I think we'll be all right. We do have the 10-year auction today at 1 o'clock. That's worth keeping an eye on as well. That's my baby. We're not supposed to have favorites, I know, but what can I say? I like it. Watch the clock. 1 o'clock, we get the 10-year note. We're going to get a lot of Fed speakers. You can also use AI on this, asking AI where the speech is going to be. Is it going to be live or not? Are there going to be questions? It won't always give you an answer. Like yesterday, it didn't know Yellen's schedule, so it wasn't really able to offer insight, but it did provide links that I could go to the Treasury Department and look it up for myself. So it's not perfect. You know, it's not going to give you every answer. But when a Fed speaker is listed here, they don't always matter. It could be a pre-recorded speech given at some luncheon, you know, in a college somewhere that has no policy statements, no impact on anything, no Q&A, no nothing, just some prepared remarks. And it would still show up here as a speech. Well, that's not one that we really need to pay attention to, right? We can just kind of ignore that one. But which ones can we ignore? You got to dig a little deeper. We are going to get some data out of Japan tonight. I'm not sure on the impact on this bond investment one. It seems like I've dug into that one before, and it's worth noting. It's worth keeping your eye on that. We'll see. You know, when it comes to econ, even ones that have been volatile before, it doesn't have to be this time, or ones that have been sleepy before and don't normally cause volatility can be this time. I don't say it enough. These market wraps are really useful. If you don't have an account at Finance Juice, I encourage you to get one. It doesn't cost you anything. You can get a free account. I have a pro one, but you don't need it. If you have an account, you can filter the news from this place. This is a news aggregate site, so it's getting news from all over the place. You kind of want to be particular about the news you get, right? There's no reason to drown in a fire hose of data, especially if it's trash like CNN, Fox Business. I mean, I don't know about you. I don't want to hear that trash. So I tend to just filter it out. What you're left with is things like this market wrap. They'll do one after we close, after the Asian close, the European close. And funny thing is, Europe isn't closed yet, but they know that we're getting ready to come in today. So they do it early just so that we have it, which is really nice. They do a pre-market one as well, kind of just giving you some highlights on the day. And it's just a nice heads up. They'll do that also for the Asian session and the European session. So it's worth just stopping by, taking a look, especially if the market makes a move during the day and you're wondering, what the heck was that move? You know, and you can't find the answer. Stop by here after the market closes and see if they talk about it in the market wrap. There was a comment that I read yesterday on the Powell testimony that if he was going to do anything else, if he was going to, you know, come out with any other statement like a shock and awe or to give us anything more, he would have done it yesterday. I'm not sure how I feel about that comment necessarily. You know, it makes sense on the surface, but I wouldn't put too much faith in it altogether, right? Just that's not enough by itself. Looking at the pivot points, we finally hit a pivot. If you remember what we've been talking about, we've had missed daily pivots since last Wednesday, and then Friday, yesterday, and Monday. We had missed daily pivots on every one of those, which is very bullish. And yesterday does count for today's session hitting the pivot today, wouldn't count until tomorrow, but we have hit it. So this is our first day without a missed daily pivot. We're already above R1, but R1 isn't the level. If you've studied any sort of gap and go strategies, what you're looking for is a gap above R2. And the problem with that is that we're at the top of the run. We've already ran since last Tuesday, so a whole week of running, and now we're at the top. You don't generally get a gap and go from the top, right? This is where you get the rug pull. You get the last hurrah, the final gasp, the last blast higher, and then the flip, and it dumps back down on our heads. This would be what we call an exhaustion gap. So we don't necessarily have much of a gap yet. Let's get a little deeper into the morning. If the market can get above 56.54, which would be this R2 level up here, this second red line, and we get into the RTH, that's the regular trading hours. If we're above that line by 9:30, then that's a gap we could keep, and we could see a gap and go play at that point. I just mentioned that we shouldn't get that kind of gap because we've just ran since last Tuesday in a nonstop move all the way up to where we're at now. However, if you look at Monday and Tuesday, we really haven't done anything, and that gave the market a little bit of a reset. It's digested this move since last Tuesday. So if you think about from Tuesday till Friday, that was the move. On Monday, we stalled out, and all day Monday into Tuesday, we've just been digesting this move. So yeah, we could break up higher from here and actually expand higher, getting a gap and go from the top of a run because we stayed here and digested the run. Is it likely? No. And if you reference the spot gamma from last night, they're actually talking about a pullback first before we go higher. Looking at the central pivots for today, today's pivot point is outside the range of yesterday's pivot point. The channels are just about the same width. It isn't decreasing or increasing. The only difference is that we've hit it today where we didn't hit it yesterday. We're still the same distance from the weekly pivot point as we were yesterday, all things being equal. And, you know, really, this isn't that far from the weekly pivot. We've seen the market get farther away than that. It also is a very wide channel, that weekly pivot, as opposed to, you know, say a week where the channel was very narrow. A wide channel implies that even if we do try to break out, that we're really not going to sustain the move. Just keep in mind that this channel doesn't make price do anything. This channel is more of a signal of what we think price could do, not what it's not making price do it. The PM edition didn't mention any changes to the call wall or the volatility trigger. And they just came out with the AM edition. So this is the stuff that we're stuck between. Massive gamma on the upside, massive gamma on the downside, this large support structure here. To bust out of this range, we need a change in the implied volatility or a change in the options positions. And they are talking about next week's monthly OPEX. Remember that options expiration is always the third Friday of the month. So July 19 next week. They're using that as the level because they're talking about a change in the options, not a change in market behavior, right? So Powell, jobs data, all of that, that's market logic input, not options data input. They are mentioning that the market really didn't seem to care much about Powell's testimony because for the most part, he just regurgitated the same thing he's been saying for the last 6 months. There was only that one new little tiny segment of the change in tone and rhetoric that he has been going through. So we do have CPI and PPI. If those numbers are kind of in line without any surprises, then they're talking about a non-event. So a lack of data, especially a lack of negative data, just opens the door for the S&P to continue to grind higher, 5,600, 5,625, and the Q's already hit 500 yesterday. So interesting that they have it listed as 500 again. Anything that puts the SPX below 5550 should send us right on down to 5,500, which is a massive support line. And they're saying that it's unlikely that we would get below that by next Wednesday. So look for any move below 5,500 before now and next Wednesday. Very likely won't be able to get below it. You can see the spot gamma index is still sitting at 2. It goes from a -4 to a +4. -4 says that if we break out, we're probably going to expand very far and very violent. +4 says that if we try to break out, it's more likely going to fail and that we don't expand at all. The reason that matters is when you get to the edge of the range on any given day, you're always confronted with the choice, should I buy this? Right? We're at rally to the day's high and we're about to break out. Is it a true breakout or should we short the high? Well, when the gamma index is really high, say 3 and 4, you want to try to short that high because it's very likely no breakout is going to last and that we'll just revert back into the range. When it's below, say 2.5, so -3, -4, if we break out, it's very likely that we're going to continue to expand. Sell the rips, buy the dips, mean reversion plays, all of that, just by looking at the gamma index. So I haven't got this shared yet because it just came out. Once I'm done with the stream, I'll get it shared so you guys can go through it a little bit slower. The call wall is right above the ADR half. We're up about 0.25%. So we're closer to the upper ADR than we are the lower one, but not by a lot. You know, if we're looking for any sort of gravity or magnetics, we're just not close enough to that ADR to make us gravitate to it. Unless we get some fireworks, I don't see any reason that we should expand beyond the range today, the red lines. I wouldn't be surprised if we hold yesterday's low and we maintain inside the upper ADR red line here. So from 5630 cog line up to 56.50. It's a 20-point range. It's really tight, and it holds us in place while we wait for CPI data. Just remember, at 2 o'clock today, we do have the federal budget announcement, and I showed where the last time we had one, there was a little volatility there. It wasn't a massive kind of move, not like a CPI day or an FOMC day, but it was a pretty good drop. Volumes are still light, but we're not seeing any hedging. So we talked yesterday about this point of control and how it's very likely not going to move for a few days because price has to stay in one spot long enough to build up volume. And we have to lose this volume down here so that this volume starts to retreat. So we need this to go down. We need the other one to go up. Because if we were just relying on price alone to build one bigger than that, it would be very difficult, right? We have to do both. We have to build one, and this has to lose some volume along the way. We're building it up pretty good. We got farther yesterday than I thought we would, but I still don't see it happening in the next day at least. So when we come in tomorrow, this should still be the same point of control as it is today. We don't expect this to move. And it's likely that it doesn't move for the whole week, but I think that's stretching it a little bit. The reason I say that is if we don't maintain the position that we're at right now, if we can't stay here for the entire week, where we go next means that we'll have to start building volume again. That could be down here in this lower area, or it could be a new area once we break to the upside and expand even higher, right? Then we'd be starting all over again. It is worth noting that below, say, 56.20, we have a bit of an air pocket. So when we break this volume level here, we got a shallow area. And that gets us down around 5,600 quickly. The VPOC from Monday is still in play. We didn't hit it yesterday, but we don't get a new one. If we were to try to map forward the point of control from yesterday, we can see it's already been hit. Now, I continue to point out, if you go and study volume profile, they'll tell you to carry forward yesterday's levels, whether or not they've been hit, right? So you would mark yesterday's value area high and value area low and yesterday's point of control, and you would plot them into today's chart. I don't do that. I've already got enough pivot points. I don't need any more. But that doesn't mean that you shouldn't. It's a viable tactic. It's been around for a long time, and it gives you insight into things that we could hit today that matter. If you think about what price did yesterday, it fell down and it hit the value area high from Monday. It didn't stop on a dime and turn around there because liquidity resides on the other side of the pivot, but it was a pivot where price did respond. If you had that level marked on your chart yesterday, you would have understood what the heck we hit yesterday when we turned around and started to hold the line there. So there is value in understanding where these levels are at, whether or not you plot them on the chart. We have a little bit of a discrepancy this morning between today's TPO and today's volume profile. We have a lot more volume at this level than we did trades at this level. These can sometimes be used in a pair group to identify icebergs and ceilings and that sort of stuff. This isn't a massive discrepancy yet, but it does stand out a little bit. We ran into a lot of volume here before we managed to spike out through it and get above it. Now we got to challenge yesterday's high and see if we can expand from there. All right, this week's range is not true. Figured that out on Monday. Every once in a while, this indicator is going to do something a little silly, especially if the previous week was a holiday week and last week was a holiday week. This week, the range is just not accurate. You're better off drawing it by hand or using the dynamic levels, because we just can't use those. In Thinkorswim code, you cannot access the data from the options chain, and that's what we need to draw those levels, right? So the information actually comes from right here, but we can't get to this using any sort of Thinkorswim code. I'm not sure how Mobius managed to write that indicator where he got this number without getting it from this location. Still, it works most of the time. We just want to recognize when it's doing something that it's not supposed to do, like yesterday. I was looking for some examples of where it's been worse. Here was an example that I found. Now, that one was pretty easy to spot and say, yeah, there's something wrong here. I mean, look how wide that thing is. It's just crazy. So sometimes it gets a little wonky. It should be back to normal next week. We're still 3.5% from the 10-week. That's right where we want to be. It's like the sweet spot. If you look back, when the market's doing good, hovering anywhere above 2.5 to 4.5 is just a really good spot to be. It's like cruise control on the interstate, right? You set it and you forget it. We're not overbought. We're not oversold. We're not overextended. Nothing. It's just Goldilocks. It's perfect. But that's the weekly. And here's the daily. So we're not overbought yet. I kind of got this line near that 1.5 area. We're not there, so we're not technically overbought. We're less than 1% from the 10-day, and we are above it. So technically we're in a healthy market, but we're kind of stalled out. You can see how these histogram bars or Schwab bars, they're really just not going anywhere, just kind of holding the range. If you look back, we don't do that very often. We usually make a move higher or lower and just get away from where we're at. There's been times where we've stalled and just not done anything, but they're infrequent. You know, usually we make a move one way or the other. The thing about a stalled market that isn't moving is it's still doing something. If you've used the RSI gear, what you find about a market that isn't moving is that it's building energy. Now I get it. You're looking at this chart and you think, well, it's moving. You know, it was at 56.30 this morning. Now it's at 56.45. It's moving. Yeah, no. Take it out to, say, a daily, and you can see that we've been holding the range. You know, we're on day 2 of an IX10. We've been in this range now for 24 hours at least, and on a bigger range, although the low end here doesn't count because we're not down there. We were in a range and then we ranged again. We came right back inside. So yesterday was just holding Monday's range. And today, so far, we've just been holding yesterday's range. We're not really doing anything. We're not going anywhere. There is a 5-bar rule. I'm not a big fan of just counting candles just to count them. And things like a 5-bar rule are a bit arbitrary, but you can't deny how often the 5-bar rule works. So if you think about the 5-bar rule, we've had 5 days in a row. Don't think about the current day because the current day isn't done yet. This bar that I'm showing, it doesn't count because until 4:15 tonight, that bar is still an active bar. It could turn red, but we've got our 5 bars. 5-bar rule says, it's five bars in one direction, and then the market pauses and digests. Now, Apple's got a history of putting that right on its head. It often exceeds its 5-bar rule considerably. But it is always worth noting when you've got too many bars in a row of the same candle, because markets are supposed to be two-sided. It's supposed to pull back. A lack of a different color shows that we're getting a bit extreme, maybe possibly overextended, parabolic, that sort of language. Now, we're not seeing it here, but if you were to go to, like some penny stocks or just some smaller stocks, and even say like NVIDIA, when it went wild, those big moves that NVIDIA made way back at the beginning of the whole thing, just parabolic behavior. Even on the intraday today, that was what, 4 big bars in a row, all the same color, and then the pause. So not quite the 5-bar. Well, I broke it. We have to wait for Thinkorswim. There it goes. All right, we seen the China ADRs trying to pick up a little bit yesterday. And over the last 5 days, they are still up more than 2.5%, but they're down this morning. VIX is down. The 10-year is down, but look, on Thinkorswim, the 10-year continues to not work, at least on my Thinkorswim. I can't look at the 10-year. It just doesn't show it to me. So I have to use the 10-year futures. So when I see the 10-year here in the watch list, I don't trust it. I don't know if it's up or down. Whatever this says, I just ignore it and I go look somewhere else. So we're going to just ignore that one. On things that are up, what's NASDAQ volatility is up. Semiconductors are up again. Surprise. Bitcoin is up. Now, it's been down over the last 5 days, more than 6.5%. So being up today could be nothing more than just a bit of a dead cat bounce or a rally off of support into resistance before flipping over and continuing the move to the downside. 1 day up isn't a sustained move or any sort of change yet. If we continue to see Bitcoin move today, it might be worth looking at the proxies. Mara, Coin, HUT, Hood, Hive, MSTR, those sort of plays. Gold and gold miners are up too, GDX, those sorts of things. The Mag 7 are up, obviously. And the rest isn't up enough. So uranium is down. That wasn't listed on Thinkorswim. It's a big gap down, and it's just an algo print. It's not any real flow yet. So we need more out of that because it can just algo print. You can kind of look back and see how it's a little wild, just gyrates all over the place. Until we get some real flows, I wouldn't count this out yet. We are back underneath the year-to-date VWAP. It's just been a sideways year in uranium, and it needed to take a bit of a break, right? It had a nice run up, and it's just been digesting up here. Long term, I'm bullish on uranium. It just all this AI needs power, right? And it needs to be consistent power. solar and wind and all that just doesn't seem to have the consistency. But for uranium, 2020, you know, when it was down at $7, it's gotten above 30. We're still digesting these highs. I still like it big picture, long term 50s, you know, over the next couple of years. Not today, at least not with this algo print. Get focused on, you know, maybe getting in around 27 if it ever offers that opportunity. Otherwise, you know, maybe getting a little bit around 28.5. We've been holding underneath this year-to-date VWAP all through June. So that is the definitive line in the sand. Call it $30. Get above that if we're going to try to challenge 32 and then, you know, get that 34 and break out. Cloud services don't usually show much in the pre-market. More often we just get a little algo print. We're not seeing that this morning, though. We got a nice big bar inside day breakout already on cloud, which is a bit odd because we've got the Mag 7 up. I would have expected this to be doing a bit better. Having said that, it is a full bar, not just a tiny little algo print. It's worth keeping an eye on. And you can see the move that we've had here. It's been just a continued drive to the downside since February. China ADRs, as I mentioned yesterday, we did get a nice bump to the upside. This is the Baba, Baidu, JD, those sorts of things. And it seemed like it was Baidu yesterday with that taxi news that really kind of kicked this into gear. Because if you look at the others, Baidu looked good, the KWeb looked good, but you know, say JD, PDD, Baba, not so much, right? So not a surprise that Baidu alone wasn't enough to continue this move. It is worth noting as a bear flag here that this is the pull and this is the flag. The longer the flag extends, the more candles we print in this flag, the more likely it is that this bear flag fails. This is my failed bear flag setup. Once we get the drive to the downside, we snap our fib lines, put the 786 on it, and we look to see price maintain in this channel. Now it can wick out above and below. That's not the issue. It's just maintaining this structure, building up more and more and more energy. If you think about what it'll look like if this flag fails to continue to the downside, it will form a cup. We would eventually go sideways long enough and then break to the upside and get the same sort of rally back up that we had on the way down. And then, of course, when we get to the top, we'd have to renegotiate. Is it going to give us a handle or not, or just give us a cup with no handle and get a breakout? So long term, and by that, I mean, you know, it could be a week, 2 weeks. We're not talking months here. Days, maybe 2 weeks at most. A little more digestion, and then we're looking for it to come out of this zone and make that move to the upside. It is worth noting we had the same thing happen back here. There was the pull, and there was more of like a bear pennant, but we were getting those lower highs and equal lows, and then it dropped out. So this was forming the same setup as if it was going to do a failed bear flag and make that move back up, and it didn't. It went ahead and fell out anyways. I point that out as a note of caution, just because most of the time a failed bear flag will happen if we stay here digesting doesn't mean that it has to. We still have that VWAP down here that we haven't touched, and that was the target. We've gotten close to it. It's really a surprise that we didn't just go on down there, but doesn't mean we can't still go down there. Nat gas is up. That thing's just been a turd. There's just nothing there. Bitcoin, more of a rebound than anything else. Dead cat bounce. Semiconductors, they're not back to the highs, at least SMH isn't. So it's off the highs. That's one way to look at it. But this is a lower high at this point. Now, as long as we keep running up and we can at least set an equal high, then sure, fine, we're good. This would just be a really beautiful scoop pattern. But we got to get it, right? By the way, there's my failed flag setup. Moved to the downside, spent time chopping here, and now we're working our way back up. It's not a perfect example, but it kind of gets the point across. This little scoop pattern or a micro cup is a nice setup as long as we do end up getting that equal high or a higher high. If this falls down, say underneath this halfback level, then that gives the market a lower high on a daily, and that's not good. After that lower high, we'd be looking for a new lower low. In semiconductors, no less. So, yeah. Inside day breakout on gold. Well, gold miners. And it's a red day yesterday. So not only is today an inside day breakout, it went from red to green also. Looking at the wicks look pretty good. You can see this buying pressure that brought it back up on both of those days. But we still have this wick here showing that selling pressure at 36.5 is going to be the level to get through. I do like it above that level, though. I think if we can break above it, we could get a nice move up into 37, maybe even 37.5. I know it doesn't sound like much, but a 25-cent or even a 50-cent move, I mean, that's all you need if you got enough shares or enough contracts. The whole idea of scalping is to take an overly large position for a small move in the market. Like that, yeah. Uranium. It seemed like we were just looking at uranium. Silver goes with gold most of the time. So gold up, silver up, gold down, silver down. That kind of correlation is how it plays. We're building a wedge here. If we're to use something like OCR analysis, you can see each day lower high, lower high, lower high, and higher low, higher low, higher low. It's forming a very tight, like an arrow. Ooh, big move, 2-year dropping fast. The 2-year just hit 4.6. Dollars dropping. Looks like we're going to test 105 and expand to the downside. We could get to 5,700 today in the ES if this kind of move continues, but we're inside day breakout, and it seems like that's going to be the test. We'll see if it sticks or not. Yesterday's breakout was an awesome short. It was like the best play of the day. So like we don't want to rally on, gold and precious metals. We want a sustained rally on big tech and, the consumer discretionary financials, those sort of things. So we want to see more of that. We got pot stocks, gold miners, silver, uranium. We've got a nice collection of things that are up. Let's just see the rest of this start to get up there too. It'd be nice to see some help out of bonds, or even just a little help out of the 10-year and the 2-year not doing things, right? Maybe the dollar holding sideways, really not making much of a move. The 10-year also, and those not moving would help us out. It doesn't have to fall. That would be nice. It doesn't have to. Just not move to the upside. That would be good. You can see the 10-year right at this third day in a row at this low. So the 10-year, the 10-day moving average, this blue line has been creeping down lower and lower. At some point, it's going to make or break. It'll bust above that 10 and run, or it'll just really expand to the downside away from it. And the same thing with the Dixie, the dollar index. Each day, the 10-day moving average has been creeping down lower and lower and lower. This is what we call correction in time, right? Versus correction in price. It's been holding these lows, the dollar and the 10-year, and it's been digesting these levels, letting everything correct itself. Now that the 10-year has got caught up with it, it could easily break over it and make its move to the upside, but it doesn't have to, right? It could tag against it and start a new leg lower before it pauses again and needs to correct, and we get the same thing all over again. This is what got my attention, that I had mentioned that the 2-year had broke down. I was looking at it on another screen. So dollar index breaking down, 2-year breaking down, ES breaking out. Watch the clock. We got afternoon data today at 2, which is unusual, right? We usually don't have data that late in the day unless it's something big like FOMC. But we got that federal budget data today at 2. So don't forget that. 1 o'clock, we got the auctions. 2 o'clock, we got federal data. The whole morning is screwed with Fed speakers and Powell and everything else. So just watch the clock, be careful, and keep in mind that today, no matter how much data we have, isn't even the big day. CPI tomorrow, that's the big day. There's really no reason for markets to break out and run in front of such a big data print like CPI. So the base case argument is that we don't break out and run. I know we just broke out, but that should fail, right? That'd be our failed breakout for the day. A nice reversal off of yesterday's high and just dump it right back down again, sustaining the move, holding the range while we wait on CPI tomorrow. That's the base case argument. Everybody, be careful, be safe, have a good day. I'll see y'all tomorrow.